Hi there, welcome to Kneppy Invest and welcome to February 17, 2025. There's about 1 hour and 21 minutes left of trading today. I've started recording this video a little bit earlier than I usually do. I like to start recording the first of my videos, which is the stock of the day, at around about 2 p.m. Brisbane time, and then I get into the ASX Daily Rundown. I started this process a little bit early today because I was looking at some land to buy during the morning, and I just arrived home and I thought I'll record these video because I expected some companies to have done fairly well today based off their results, and I was blown away by one company's market reaction in particular, and that company is a stock of the day, Audinate, share price up 33%. I expected a pretty good reaction from the market when it came to A2 milk, so that was not as big of a surprise, and probably Bendigo Bank's share price decline was a bit of a surprise as well. So I'm sort of going into this video a little bit blind, but that's okay because I don't mind doing that. Now, there is a chance this time tomorrow I will have bought some land. So I'm at about 75% sure at this point in time. Okay, so what I'll do in today's video is I'll go through the ASX today, looking the best and worst performing companies. Then we'll have a look, or not only companies, but also indices and also sectors. And then we'll have a look at the top 5 stocks of the day. There's a chance I probably left out 1 or 2 companies that have performed or done badly. But the top 5 stocks of the day, all the share prices of these companies are either up or down by over 10%. And I'm very thankful that I own 2 of those companies that are up by over 10%. In fact, I own one company that is up, whose share price is up 33%. Although I'm a little bit upset, not upset, that's probably being a little bit over dramatic. I was hoping that Audinate share price would go down a little bit more. I'll be honest with you, I was hoping that before the market realized that the short-term hit to the revenue and the profit was short-term. But the market has reacted as I think it should have. Anyway, so a little bit peeved, I don't know what the word is. But anyway, so we'll do the top 5 stocks of the day, and then I'll answer some of your questions. And there is a question in regards to where I live. Do I own my own house or am I renting? So I'll answer that question as well, although I've given it away already. Okay, so let's have a look at the ASX. Actually, before we have a look at the ASX today, let's have a look at the earnings calendar because we're in the peak of earnings reporting month. And quite a few companies released their results today, including Bluescope Steel, share price up 10% last time I looked. That is in my top 5 stocks. GPT Group, Bendigo and a bank, share price down significantly. Horizon, Lendlease, 2 really companies. 2 companies I'd never own for the long term, Horizon and Lendlease. And we also had GWA Group and Audinate. A2 Milk's not here. Or maybe it's down a little bit further. I'm not seeing it here. Anyway, we also had Fiducian release their results, shareholder. Happy to say share price is up 10%. HiTech Group just released their results. Small cap company, one of the best performing small cap companies over the last 12 or so years. And the share price, I think, was up a little bit. And Odell Beauty released their results as well. Nothing much to see there. Tomorrow, what have we got in store for tomorrow? We have BHP, James Hardie, Dexus, Hub24, Minres, Challenger, Reliance, ARB, Judo Capital, SiteMinder, Monadelphous, SG Fleet, SRG Global, that's the one I'm keenly going to be looking at. McMahon, Infomedia, Hum Group, Solvar, another one I'm looking forward to. Oh, just list goes on and on here. What another epic day we have in store for tomorrow. Okay, let's have a look at the ASX today. And not surprised to see the market down. I'm not surprised at all. I hinted that yesterday because of the weak lead-in by Wall Street, particularly the Dow Jones, not the NASDAQ, Dow Jones. We tend to follow the Dow Jones more than the NASDAQ. So if you see the NASDAQ up 2%, but the Dow Jones down 2%, we're more likely to be down than up on that particular day. Our market is more like the Dow Jones and NASDAQ. If you don't understand why, you might have to try to understand the definition of tech stocks. And we don't have many tech stocks on the ASX compared to the NASDAQ. NASDAQ is just full of them. And our ASX 20 there's hardly any. We are dominated by banks or financials and mining, and they're not growth. Well, mostly not growth or tech. What else? The resources down a fair bit. Small caps have had a good day. Go small caps. Always good to see. Sector-wise, and by the way, the market has been fairly flat during the day, although tech has been going down slightly all through the day. Best performing sectors, staples had a good day. Real estate, pretty good day, probably led by Goodman Group, I'm assuming, and utilities discretionary. So definitely a bifurcated market here. Some sectors really good, some sectors really bad, and energy financials had a bad day. I'm not shocked with financials because of Bendigo Bank. Also, Westpac did release, there was some sort of update, Q1 update, Q2 update, something like that. And I think share price of Westpac is down, but I'm wondering if it's financials being led down by Bendigo Bank. Why is Staples up? What's happening with Staples? And there is a store in America called Staples. I'm pretty sure it's like Officeworks. I don't ever remember going into Staples, but I wonder if they sell staples, staples that you put two pieces of paper together. Anyway, let's have a look at Staples. Oh, the A2 milk. A2 milk, well, yeah, A2 milk's had a really good day, yeah. That's sort of understandable. Okay, let's move on. Indices wise, ASX 20 down 0.7%, banks down 1.77%, and gold down 3%. Gold's had a pretty bad day. That's a little bit of surprise. No, it's not. Try to remember what went down big. It was copper that went down big after our market closed on Friday. So I expect companies like Sandfire to be down fairly big. Let's see if that's true. Oh, Sandfire is up. There you go. I wonder if Hillgrove Resources is down 4.26%. Some reason that decrease in copper prices hasn't affected Sandfire, but it has affected Hillgrove. I can't remember if gold had a negative day. I'm pretty sure. Oh, that's right. It did have a pretty negative day on Friday. And if you have a look at the 5-minute chart, just with gold, the gold really collapsed at about 9 p.m. on Friday evening. And that is why gold's down today, although it's starting to rally now. So hopefully you haven't sold out completely of gold in the morning because you might have sold at the bottom of this little short-term downtrend. Okay. Now let's turn attention to the ASX 20, down 0.7%. I would not be shocked if most of the banks are down. I'm not sure about iron ore, can't remember. I'd say 6 companies up, 14 down. 5 up, 15 down. And the biggest company, or the companies up today, have been Aristocrat, Transurban, Woolworths, Wesfarmers, Macquarie. Not seeing Goodman Group there. And the worst performing companies in the ASX 20 have been Westpac. Yeah, they did release an update. And it's not that usual to see a big bank like that down 4.84%. And it's not usual to see another bank, even though it's a regional bank, down 17% on results. That was a shocking result from Bendigo Bank and a pretty shocking reaction from the market. Woodside Energy down and quite a few companies down by more than 1%, including NAB, CBA and ANZ. So a lot of weakness in financials today. So there's going to be a lot of shareholders or a lot of investors in Australia that had a bad day because banks are down broadly. Okay, so let's turn our attention to the top gainers of today. There is one company I missed, Chalice Mining. I did see that up a fair bit, but Audinate, best performing company today. And we can sort of ignore the next 3 companies. They're up on fairly low turnover. And there's Chalice Mining. I did miss this one. Share price up 27.1%. So let's turn our attention to Chalice Mining. And the reason I know that's up because I did open up Market Index just to see their commentary on some of the performance of the companies today. And Chalice Mining is featured here. So they just mentioned shares in Chalice Mining soared 33% after the company reported a major metallurgical breakthrough. There it is, major metallurgical breakthrough at Gonneville. I wouldn't know how to read this at all. The test works results mean the project will no longer require a hydrometallurgical process for the nickel concentrate, reducing capex by approximately $500 million and life of mine operating costs by $990. Well, no wonder the share price is up. They just said they're saving virtually $1 billion over the life of the mine. Yeah, no wonder the share price is up. Chalice remains one of the most heavily shorted stocks in the market. There you go. So a bit of burn for the shorts. So let's have a look at the chart for Chalice Mining. Is this a breakout? This was definitely a bit of a story. That's a 5-minute chart. This was definitely a bit of a market darling not that long ago, maybe 3 or 4 years ago. And share price just going sideways now. It's in the consolidation phase, basing. If the share price drops below $1, time to buy. Now it's at $1.50. But I wouldn't say this is necessarily a breakout. We're not at a 3-month high. Very close, but not quite there. And if you have a look at the weekly chart, yeah, it wasn't that long ago. Yeah, the share price reached a high of 1050. A lot of interest in this company in late 2020 into 2021. I still remember the chart, still remember the interest in this company, and that interest has died away. So not yet in production. Okay, so that's Chalice Mining. Just looking for other interesting high turnover top gainers here. We have A2 Milk. I'll talk about that company in the top 5 stocks of the day portion of the video. That's really it. Nothing else here of note. So let's turn our attention to top gainers by market cap. Bluescope still. That is in my top 5. GPT Group is not. In fact, I didn't even have a look at their results at all. Not the sort of company that I am attracted to. Anyway, so some sort of, I think it's like a real estate sort of company. Announces its 2024 annual, what was that? Announces its 2024 annual result. So they just had their annual result, not half yearly. They have a funds from operations. So this is more of a REIT. I thought it was a developer, not a REIT. That shows you how much I know about this company. Anyway, so let's have a look at a chart for GPT. I wonder if I do have this in my REIT watch lists. Let's have a look at the chart. And this chart, this weekly chart that goes back to 2018 is not a chart I would be attracted to. So you can definitely see why I don't follow this company at all. The share price has gone nowhere over the past 6 years. And let's just have a look at the daily chart. Maybe this is a short-term breakout. Yeah, maybe. Anyway, so is this in my REIT watch list? Oh, it's in no watch list. There you go. I might put it into my REIT. It's either in my REIT or real estate watch list. Let's go back to the top gainers. Zip's had a pretty good day. Vulcan Energy, Audinate, Synlait Milk, up another 9.8%. I wonder if that's on the back of A2 Milk. Metals X, that could be a breakout. I just featured Metals X, not featured. I did have a look at this company yesterday in the technical update video. They're a tin company. Tin looks okay. And I was saying this could break out, maybe, because that price at 50 cents is a resistance level. And this is a definition of a breakout. Metals X. Now, it is a commodity-driven company, and I'm less attracted to breakouts for these type of companies because it all depends on tin. And if tin starts to go backwards in price, then Metals X share price will go backwards. But this is and does look like a breakout. And what else? Tyro Payments. There was a bit of a mention in Tyro Payments, but I didn't have a quick look at it. Tyro Payments. Where did it? Maybe it was Capital Brief where I quickly saw it mentioned. No, where was it? Let me just have a quick look. Here it is. Oh, market index. Yeah, Tyro Payments. There was an AFR article which stated that the company is making it clear it is willing to discuss opportunities with potential suitors. Okay, so this is a potential takeover play. So let's have a look at the chart for Tyro Payments. And this chart has not been looking good. Same with what's the other one? Not Smart Parking. What's it called? Smart Pay or something like that. Anyway, this chart does not look good. There's a downtrend right there, and share price is still below the downtrend. I don't or would not consider this a potential trade at this point in time. So let's move on to Star Entertainment Group did announce potential funding. They made that clear. It's just potential funding. And it's with some sort of private equity maybe. Who was it with? Debt refinancing proposal. Oak Tree Capital. Maybe it's not that one. Oh, it is that Oak Tree Capital Management. There we go. So this is $650 million. And they They mention here the board will consider the proposal. There is no certainty that the proposal will be progressed. So actually, this does decrease the risk in starting a Takeover group right now. And that's why the share price is up a little bit. Hum Group up, Findi up. So Findi did, actually before that, Fiducian up. I'll talk about that company, but Findi up 8.11% on the back of a market update, and they did receive more ATMs from the Bank of India. There it is, 900 ATMs with Union Bank of India, and 2,290, oh no, I'm sorry, on the wrong day. 2,293 ATMs and financial year 25 guidance update. Funny enough, they released another announcement in regards to the guidance update, but I think that was a presentation. I'm pretty sure these ATMs are with the Bank of India, State Bank of India, yeah, Rothschild's investment back. And their upgrade guidance was interesting. They actually decreased their revenue guidance, and I thought, oh, maybe the market won't like that. But EBITDA guidance of 30 to 32 million and revenue guidance 68 to 70 million. And they are expecting significant growth in financial year 26. Now, if they don't get great growth, they could be on, I wouldn't say problems, but if you have a look at their presentation, they are expecting and sort of hinting at pretty big growth. Where is it? No, it's not that forecast. It's right here. Here it is. Findi has line of sight of a step change in revenue. So forecast, but they don't have a number here. That's a problem. They could say that. They don't have a number. So they've got $70 million for financial year 25, and then all these step changes for the revenue to increase, but they don't have an expectations for revenue in financial year 26. They did mention it will be delivered to the market at the end of first quarter. So the increase could be 1 cent. And they could not be wrong here. So I sort of understand what they're doing here. It looks pretty big. In fact, if you just say it's like more than doubling in revenue if you just take the sizes of these bars here. But I think that's the wrong way to go. I've seen companies do that before where they do trick investors by doing that sort of thing, and the increase is not that great. Nowhere near that great. And what else do we have? That's about it. Oh, Paradigm Pharmaceuticals. We want that to go high so I can exercise my options in about 1 year's time. Now on to the top 5 stocks of the day. I've already mentioned Findi, State Entertainment Group, and the other company I just wanted to mention was Westpac. Share price down 4.31%. That's probably on the back of also Bendigo Bank having a bad day. First quarter update. Look, they have statutory numbers and also underlying numbers. And statutory numbers were negative. Where is it? Here it is. So we have statutory numbers down. So we have been looking at net profit after tax down 9%. But if you exclude notable items, profit after tax is actually up 3%, which is actually better than CBA. CBA's share price rose. Westpac actually fell. Return equity up to 10.5%. From 9.4%, and return on average tangible equity up to 11.8%. So I didn't think this was necessarily all that bad compared to, say, CBA's, but the market didn't like it. Just want to see if I did any notes here. No notes. There was notes on Bendigo Bank, but that's it. Anyway, so the market has responded a bit negative to this update. So let's have a look at the chart. Is this a time to panic if you own the banks? I think the answer to that is no. At this point in time. Now, this was a little bit of a hit to the share price, but not a big hit to the chart. Share price still an uptrend for Westpac, and we have seen a little bit of buying coming in today. So there are some people that are keen to buy some Westpac shares. Not sure why. I would still say this company is overvalued, but not as badly as CBA. Okay, so that's the only company that did not make it in top 5 stocks that I haven't talked about yet. And a few other companies released results today that I have not mentioned. A company called Freightways, FRW. Now, there's no point talking about this one, even though I am talking about it, because this company, even though it has a markup of $1 billion, maybe $1.5 billion, if you have a look at the depth, there's only one buyer, no sellers. So we can just move on. I actually did have a quickly look at their results, and I thought, oh, it's pretty good. But then I have not heard of this company. I don't know how long they've been on the ASX. I would say they're dual listed on the New Zealand Stock Exchange as well. And yeah, my question would be why? If you own this, why? It's too illiquid. Other companies, Adore Beauty. Yeah, I think I might have slightly mentioned that one. and HiTech. Let's briefly touch upon HiTech. They did release their results after market had opened, so I quickly called this one, and share price up 2.6%. Now, this is has been one of the best performing small cap companies over the last 12 years. So profit up 14%, EBITDA up 8%, and a dividend of 5 cents per share. So it's probably, together with the full-year dividend, not a bad dividend yield, I think. Anyway, so nice growth. Yeah, nice growth for HiTech. We'll have a look at the chart for this company, HiTech, H-I-T. And yeah, the chart's doing nothing for me at all. No interest in that chart. Okay, so let's see our attention to the top 5 stocks of the day. A few companies in this list, I did not have a look at their results because I was on a little bit of a rush, but I can't ignore how the market has reacted. The first one of those is Bluescope Steel, up 12.15%. I have traded this company in the past. Not a quality company, not a long-term hold. I would trade this company again. And in fact, I'd trade any company again, to be honest with you. Anyway, so let's have a look at their numbers. Now, one of the things I did discover was Market Screener. Now, this is maybe something I should do a little bit more of, because you can find market expectations via this. Analysis forecast in the financial sections, and Bluescope Steel, if you have a look at the half year, pretty sure this was half year numbers, yep. So if you have a look at the headline numbers, and let's have a look at profit. So the analysis, we're expecting profit for Bluescope Steel to be $166.2 million, and it came in at $176 million. That's a beat. That's a beat. That's a beat. So profit expected 166, came in at 176. I'm just going to confirm that. I do have, yeah. So according to Market Index, revenue was a 6% beat versus RBC Capital estimate. So they might not use the same thing as Market Screener, but it looks like it was a beat. Funny enough, revenue down 7%, EBITDA down 3%, profit down 63%. All those were down, but they all beat market expectations. EBIT guidance slightly below expectations, but implies an inline full-year result. There you go. They also have underlying EBIT, $309 million, and EBIT expectations were $294.5 million. So that's a beat. I'm going to have to delve into this a little bit more just to see where they get these analysis estimates. This is the first time I've seen this anywhere. The only platform I know that has this, and that is why I instantly, I wouldn't say fell in love with Market Screener because I haven't explored it that much, but I do like what they've done here. It gives me access to how a company performance compares to expectations. Before today, I've had to do my own research, do my own, find my own numbers, go through previous results. Sometimes I'll go to Market Index, Capital Brief to get some information, but Market Screener is going to provide me that moving forward. Anyway, so Bluescope Steel beat expectations. Full guidance a little bit weaker than expected, but still in line with full-year results. So let's have a look at the chart. Is this a breakout for Bluescope? And share price at $25. The last time share price was this high was way back in 2021. And it only stayed at that level for a short period of time and then fell away. This could be considered a breakout for Bluescope Steel. Pretty good trading day for the company. Share price easily went above $24. That would have been a resistance area, sort of a zone between 24 and 23.50. It blew past that with ease. I would prefer to see a little bit higher volume coming in, but this could be considered a breakout, apart from maybe the volume. So congratulations to Bluescope Steel. Now on to Fiducian. So for full disclosure purposes, I do own shares in this company. Share price up 9.84%. Share price has been up over 10% for most of the day. This company is a long-term hold for me. I think this company could be considered high quality, and I've held this company for a long time. And if you've just held shares in this company over the last 10 years, you have significantly beat the market. So this is the sort of holding where I'll just see the results and that's it. And I won't sell. Anyway, so let's have a look. In fact, let's go to, I wonder if Market Screener works for all companies. I think it works for the bigger companies, but does it work for, looks like I'm going to have to register. There you go. Financials. Looks like they don't have any analysis expectations here. And yeah, or maybe I need to register. Anyway. Oh, wait, where is it? Where is it? Oh, here we go. Half year presentation. Yeah. No, we'll do this one. Yeah, why not this one? The results were, well, I didn't have any expectations. I just wanted to see more growth. So revenue up 14%, profit up 26%, dividends up. This company has continually increased the dividends year after year after year, or maybe 1 year they haven't increased the dividends. Let me just confirm that. Try to have a look at the dividend history via ComSec. No, they've increased the dividends year after year. So back in 2015, they probably had a dividend of maybe 10 cents. Now it's up to, probably, was it up to now about 39 to 40 cents. So they've quadrupled the dividends in the past 10 years. That's exactly what you want to see for a long-term hold. And if you have a look at their financial metrics, just continually increasing over time. And we can do that via FinChat. So let's have a look at FinChat. Why do I own this company for long-term? Why do I consider Fiducian to be a high-quality company? Now, there are some things I won't talk about, so not talking about moat or anything like that. In fact, I wouldn't consider this company to have a strong moat at all, but it's just the consistent growth in their financial metrics. So markup is only 288 million. So some people would say that's fairly small, but this company has just grown and grown and grown. So revenue growth over the last 10 years, 13.5% per year. Earnings per share growth over the last 10 years, 14.1% per year. A dividend per share growth, 15.8% over the last 10 years, exactly what you want to see. Return on equity is at 27.9. Return on invested capital is at 31.2%. P/E ratio is only 19.2, so it's not that expensive for a company that's growing like this. I just think it's the moat is the only thing I would be questioning, I suppose. So for this company just does funds management, financial planning, and platform administration. I'm pretty sure financial planning has really low margins. In fact, we can confirm that right now because they do have this in their presentation. And they do compare all three of their divisions somewhere here. Where is it? I'm pretty sure it's here. It is, this bit here, segment reporting. So I'm pretty sure financial planning has the lowest margins. You can see the revenue for all three are between 11 million and 16 million, but the margins, they don't have the margins here, but the profit for funds management at 8.9 million, financial planning at 2.3 million, and platform administration 6.9 million, almost 7 million. So the margins in platform administration pretty good. So we're talking about over 50% margin from revenue to profit. And even funds management has a pretty high margin as well. And financial planning margin has, what's 2 divided by 14? Probably about 30% margin, if that. If we times 15 by 6, we'll times it by 7. So 2.3 by 7, we're talking about a 16% margin. So really low margins financial planning. If they decided to sell one of their divisions, that would be the one I would sell. And then you really increase the the efficiency of this company. Here they go. They always have this. Fiducian outperforms against all odds. So Fiducian share price over the past, well, since they listed, I think, or June 2012, share price has gone up 1,211%. No, 1,466%. Compare the all odds up 255%. And I'm assuming that does not include dividends. It might, but I'm not sure. Compounded return. No, if it's compounded return, that should include dividends. So, yeah, it's significantly better market over the last, oh, there we go. Dividends, 1,000 invested in July. Yeah, the dividends have increased year after year after year. Yeah, they have. And the yields has been, yeah, if you bought in 2013, your yield on your initial capital is at 41% now. 41%. That's the benefits of a high-quality company that is growing. You just see a much better return on your initial capital. If you bought Telstra, your dividend yield hasn't changed over the past 10 years. In fact, it might have gone down. Telstra is not a high-quality company. Anyway, that's Fiducian. Now let's have a look at the chart. Spend a little bit more time on this than I really wanted to, but that's okay. Chart probably looks pretty good. Yeah, no problems with this chart at all. Share price was under a little pressure for about a 2-year period during the time interest rates were rising. And that was a beautiful time to buy some shares when we saw the end of 2023. But if you have a look at the weekly chart, and then put in the 200-week moving average. There it is. Well, yeah. So that period in 2023, when the share price fell below the 200-week moving average, was a prime buying opportunity. The other thing I should mention, share price has reached an all-time high. There you go. Go Fiducian. I've held this for a while. Can't remember when I bought, but I've held this company for a long time. No, I have no reason to sell just yet. Okay, on to number 3. We have Bendigo Bank. And this was an absolutely disastrous result. Share price down 15.8%. We have seen a little bit of buying coming in. The low of the day has been 1087, current share price 1130. So some people are going, oh, maybe there's some value in Bendigo Bank. I would say just be careful. Just be careful. Look at the dividends. Compare that to Fiducian. There's no growth in dividends at all. That is a problem with some companies on the ASX. You have no growth. You might get a nice dividend yield, but no growth. What you want is a company with an okay dividend yield that is growing their dividends over time, because eventually you're going to have a pretty good dividend yield from that initial investment. Anyway, so Bendigo Bank did release their results today, and my first thoughts were, when I saw these results, the media announcement was, ugh. That was my first thoughts. I was like, it's negative. It's completely negative. So the banks have been comparing their numbers to like statutory numbers, underlying numbers. And for CBA Westpac, the underlying numbers were up a little bit, not a lot, but up a little bit. So at least that's okay. It's up. Bendigo Bank, no, down. So the other thing I should mention is like CBA compared their numbers this half year to the previous corresponding period, and also compared to the last half year. And there was a reason behind it. Bendigo Bank has done the same thing. They've compared it to both the most recent 2 half years, so previous corresponding period and the last half year. So first half of 2024 and the second half of 2024, all down. In fact, down 9.7% from the second half. I'm not sure why they included that, because the numbers look really bad. They should have not even compared to the last half year. They should have just compared to the previous corresponding period, because everything's down. Statutory profits down, net interest margins down, except it was up by the previous corresponding period. Residential lending up, dividend per share at 30 cents down, cash return on equity down to 7.55%, and common equity tier down, customer deposits up. So residential lending, customer deposits up, but who cares about that? Everything else is down apart from one net interest margin. They did have some maybe not excuses, but reasons why. Richard Fennell mentioned, we have experienced significantly increased demand for both lending and deposit products. Yes, we saw that, which has led to the strongest balance sheet growth we have experienced in some years. I'm wondering how they define balance sheet growth. However, and whenever you hear however, you know something bad is coming. Our earnings have been challenged both on the income and expense lines. Income was impacted by margin pressures, driven by higher funding costs to support accelerated lending growth. Expenses have also increased due to continued investment to deliver our transformation program. The market has said, we don't like this, Bendigo Bank. You suck. Share price has sold off like I've never seen with a bank before. Share price down 15%. And this is the chart. Probably not a good chart as we have seen from the banks. I should put that in it, from the banks. So definitely CBA's chart looks much better. Westpac chart looks better. Even ANZ chart looks better. But the share price had been rallying. I think just the bullishness in banks had been rising share price of not only Bendigo, but also Bank of Queensland. No real reason behind that. These are low quality, really, among the banks, these are really low quality. Markup 7.6 billion, and even the P ratio is at 15.4, which is way too high for this type of bank. So people are just buying banks because it's the in thing, and maybe today the tide has turned, and the chart, yeah, this could be a trend killer. This could be a trend killer. Now, if the share price falls below this purple box, I would confirm it. That purple box could be a support level for Bendigo Bank, however. Okay, so negative, Bendigo Bank. A2 milk. When I read this, because this was the first results released today, when I read it, I went, this is going to be the stock of the day. I was thinking I should just record the video now. Stock of the day, no problem. And then Audinate came in and blew A2 milk out of the water. Now, when I say blew A2 milk out of the water, I'm talking about share price rise, not necessarily a result. Funny enough, I did go to Copper just to see how the market was reacting. And one person said, oh, these are poor results. And I was like, eek, eek. You can't look at these results and think they're poor. That's not a, anyway. Which one should we look at? In fact, let's go to maybe the media release. Try to remember what I looked for or looked at. Okay, so actually what we should do is go to A2 milk in market screener. Or maybe I can't do it because I've used too much. Oh, there we go. Just wondering if I cannot use this much anymore. Oh, and I've got analyst forecast here. Hopefully we can see this. Name will go to half year. So apparently you can still look at this, even though you're supposed to register. So sales, this is in New Zealand dollars. That's good. So expected sales are 876 million. So let's compare that to what they produced, 893. So revenue, better than expected. Net profit after tax, 91.7 million. Expectations, 82.3 million. So profit better than expected. Revenue better than expected. What does that mean to the share price? Well, if the results better than expected, share price should rally. There you go. I knew the results were better than expected, and they also produced a pretty bullish outlook. I think it was an upgrade. Could have been an upgrade as well. I'm trying to remember if it was an upgrade. I'm pretty sure it was. Yeah, revenue and earnings guidance has improved. Yeah, revenue and earnings guidance has improved from the company's prior outlook statement, 22nd November 2024, due to these reasons, 4 reasons. And then our company is expecting revenue growth of low to mid double digits. That's pretty good. Gross margins to be up, market expenses to be up, EBITDA margins to be slightly up, operational cash conversion to be approximately 90%. Now, the other thing I should mention here is the cash on hand for this company has increased to $1 billion. Yes, $1 billion. So this company has a lot of cash on hand. So you've got to take that into account when you value this company. So I'd say the market cap might be like 4 billion. I could be wrong there. 4 billion. 5 billion now with the share price increasing. So the enterprise value of this company is around $4 billion. So I wouldn't say this company is overly cheap, because if you have a look at the earnings per share, 12.7% or 12.7 cents for the half year. Now, this is in New Zealand dollars. So we could just say earnings per share for the full year, 25 cents. If we were kind, we'll say 30 cents. So that would mean the company is trading on a PE ratio more than 20. But the company is seeing some nice growth, or expecting some nice growth in the next year. Okay, more importantly, is this a breakout for A2 milk? I expect it is. I expect this to look okay. In fact, that's the weekly chart. Oh, in fact, you can see this in the weekly chart. This is brilliant, brilliant. So there's definitely a bit of resistance around there where the share price is right now. You can see the share price has tried to get above that level a few times in the past, 3 years almost, and it's getting there right now. It's there right now. Look at that. It's there right now. So it's definitely in a resistance zone. So this is a breakout or potential breakout. Now the share price is at a 6-month high. That's important. Positive financial results, yes, and pretty good volume coming in, really big volume coming in. So there was that one company today, who was it, Bluescope still, that the volume wasn't as high as I wanted. This volume is brilliant, really good volume coming in. This is a potential trade. I will say that this is a potential trade. Maybe the valuation is the one thing against A2 milk. Maybe if you're being very picky. Okay, and the stock of the day was Audinate. So A2 milk up 18.8%, and Audinate last time I looked was up 33%. It's only up 28%. So we're seeing a little bit of selling coming in. Share price was above $10. Now it's down to $9.71. That's understandable. If we do see the share price pull back significantly more, I would be buying more shares in Audinate. So the results beat expectations. And they also mentioned that this, what do they call it, inventory problems the company is experiencing because their clients had a little bit too much inventory on their books. That's been wound through. And so they're talking about everything going back to normal in financial year 26. So things are moving towards the right direction or in the right direction for this company. And the very fact that the results were better than expected, share price has popped up. I would say there might have been some shorters as well who got caught out. So pretty good day for Audinate. In terms of chart, I don't think this is, the share price is at about a 4-month high. It does look interesting. I'm close. I don't think it's good as A2 milk. Oh, it's getting close. It's getting close. I'm not sure which one I like the best, but they both have done fantastically well today. Okay, let's turn our attention to some of your comments. Let's just refresh this. There we go. Robin Pecuravilla, Australians love Chemist Warehouse. I think this one is next Afterpay moment. Probably just the valuation is my big question about Chemist Warehouse. However, with their rollout plans, their international rollout plans, I could imagine this company experiencing some pretty good growth over the next 5 to 10 years. Not sure whether I say this is the next Afterpay moment. I think they're completely different companies. By the way, Afterpay was never profitable. Chemist Warehouse is definitely profitable. So if I had to pick between Chemist Warehouse and Afterpay, I would pick Chemist Warehouse all the time. It's valuation. I just don't know. Video idea, how much needed to recover losses? Oh, yes, I see what you're saying here. So if the share price drops 50%, you need it to rise 100% to regain your losses. That's true. If the share price drops 90%, you need the share price to be almost a 10-bagger to recover your losses. Yes, this is absolutely true. That's why I try to limit my losses and ride my winners as much as possible, because the gains can be significant. And if you have a company who's down 90% in your portfolio, it's only down 90%, but it's still a significant loss, and it has to recover a lot for you to get your money back. So that's one of the reasons why I do like to sell my losers and ride my winners as much as possible. I think there is a comment about that somewhere here. Who was it from? Oh, it's from what's his name? The James Dean. It's somewhere here that I'm probably missed. Anyway. CJ Smythe, SML, NZX up 30%. SML, what's SML? Oh, Synlait. Okay, that makes sense. Yeah, Synlait. Funny enough, Synlait milk today, let me have a look at what share price Synlait milk is. So I bought Synlait milk at 44 cents. Oh, it's close to, it has been, it's close to doubling, very close to doubling, up to 83.5 cents. And I was concerned about the chart, I think late last week, just because the share price is just accelerating. I don't really like this this gap it's formed today, but the share price has held strong today. So we haven't seen a lot of selling, but more of a doji. So not as bullish candlestick as we have seen in the past, but this could be take the profits, maybe sell half and just ride the rest. I wouldn't be surprised to see the share price pull back a little bit, just because how much the share price has risen in a fairly short period of time. But it wouldn't be surprising to see the share price significantly higher in 6 months' time. So that's another reason why I'm a little bit hesitant to selling, because I could imagine that scenario playing out. Thank you, Sankar. Very welcome. YourFrienjamin says you can cut only so much costs. Income must be focused. Income must be focused. One of the reasons why I look at revenue growth first, foremost, is because you need to see a company growing their revenue over time, because if they can do that and maintain their margins or even grow their margins, that's the best way for a company to grow their profits over the long term. A company can't grow their profits over the long term by cutting costs or even by increasing their margins, because margins can only increase so far. So for me, a definition of a high quality company is one that can increase their revenue over time. For instance, Telstra cannot do it. They don't increase their revenue. Thus, Telstra is not, by my definitions, a high quality company. Even CBA, which does increase their revenue over time, it's too low. The growth in revenue is a little bit too low for my liking. So cost cutting, I'm not a fan of it. I think short term maybe, but that's it. Very short term maybe, but over the long term, you want to see the cost actually increasing through time, because that's also, how a company grows. They increase their costs, increase their whatever, marketing, labor, that sort of thing. Ibrahim Salbo, wage increases are also inflationary. Yes, they are. Wage increases, it's what's it called, the wage price spiral. So wage increase is definitely inflationary. Adding to the effects of tariffs could cause the Fed to reverse the decision to cut rates. Well, they're not cutting rates no more. And Powell says we're holding back now. And the main reason I think behind that is because Trump got in power and they know that his policies are inflationary. So they don't want to cut rates, because that could be the worst thing in an inflationary environment. Cutting rates could add to inflation by a significant amount. We saw this in the 1970s. They cut rates too quickly, and we saw a major return to inflation. In fact, I could show you that. I think inflation. Let's see if this works. We'll get rid of the moving average. Here it is. No, that's the 1970s. Here it is. So this is 1970s. This is inflation. So it lulled. There was a lull in 1972. And then it ran rampant in 1972, 1974. And then it fell a lot. They cut interest rates at this point. And then just look at how much inflation just rose. And then what's his name? Volcker got in charge of the Fed. And he just went hard when it comes to interest rates. He just wound up interest rates like there was nothing else. If you put interest rates on here, interest rates, USA, is this the one? Yep, here we go. Here we go. In fact, you can see correlation here pretty well. So inflation reached a peak in November 1974, and they started cutting rates almost immediately. And then inflation fell and then started rising, and then they had to raise interest rates immediately. Anyway, and you could see when they didn't cut interest rates until they were pretty convinced inflation was coming down. And there's a pretty good correlation. Except here. Anyway. Okay, so how many more questions shall I do? Here we go. Sensei 6011. We'll end it here because I was thinking about this question. Kneppy, do you own any investment properties in Australia? No. I think I'm a better share investor than a property investor. And do you own the house you live in? Yes. So I have no mortgage. Completely own it. And do you currently rent? No, I'm not renting. So sold the house I'm currently in, and then I'm going to buy some land, hopefully, and build a house on that. And potentially I'll have a new house in about I'm hoping, if everything goes right, the house would be built by November, December of this year, if everything goes right. Don't forget, 1 year I'm on leave, don't have to work for a year, so I can do whatever I want during that year's period. So, and the house might be built during that year. Anyway, so that's what I'm doing. I know some people love investing in properties. It's just not for me, that sort of thing. I get better returns from investing in the stock market. Suncorp fell as it did a capital return of $3 per share. Suncorp. Why is Suncorp not showing up here? Suncorp. Did Suncorp change the name? Suncorp. It's coming up in TradingView. Why is Suncorp not coming up? That's weird, ComSec. Okay, let's go have a look at this. Suncorp. Oh, SUNDD. Okay, SUNDD. What's happening here? Temporary ASX code, consolidation split, cash return of capital. Is that because they sold the bank? Is that what's happened here? They sold the, didn't they sell the bank to ANZ? And oh, this is just goes on. There it is, $3. $3. When was the ex-dividend or record date? 18th of February. Today, that's today, 17th of February. So share price should have dropped a lot today. Anyway, that's Suncorp, and that will be the last comment of the day. Anyway, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.